Today, we're talking about accountants and commercial lending. If you're an accountant with business clients, you are already sitting on more loan opportunities than most full-time brokers will ever see. But here's the part that almost no one explains clearly. You don't need to stop being an accountant to unlock these opportunities. You're already upstream of the best deals. And in this video, I'm going to show you why that upstream position is so valuable and why most accountants never monetize it, and how the ones who do and do it right expand their advisory role without damaging trust or becoming salespeople. But first, let's be very clear about what this video is not. This is not a pitch to quit accounting. You shouldn't. This is not about selling money to tax clients. You shouldn't. And it's not about chasing commissions or relabeling yourself as a broker. Again, you shouldn't. This is about something more nuanced and far more sustainable. It's about expanding your advisory role so that capital strategy and, when appropriate, capital placement become part of the value you deliver to clients. Done intentionally, done ethically, and done without undermining all of the trust that you've spent years building. And in a moment, I'm going to show you why accountants often see better commercial loan opportunities than the loan brokers who are doing this full time, and why lenders care so much about this distinction. I'm Shane Walton. I co-founded the Commercial Loan Broker Institute, and this has given me the opportunity to support hundreds of brokerages around the country. And from this work, a clear pattern has emerged. Some of our most effective brokers that we support, they started out as accountants. Some were CPAs, some were tax auditors, some were tax preparers, bookkeepers, some were forensic accountants that were called in as hired guns. But across all these different variations, they didn't succeed by becoming more transactional. Universally, they succeeded by stepping into more of an advisory role and providing even more service and value to their clients. And if you go out and you ask most accountants or bookkeepers to describe their role, the answers are going to be familiar. I prepare taxes, I close the books, I keep clients compliant. And all of that is true, it's just incomplete. In practice, accountants sit at the intersection of cash flow, growth, risk, and timing. If you look at the questions that clients are already asking you, can we afford to hire? Is it safe to expand? Should we buy the building? What happens if revenue dips for a few months? Those are not bookkeeping questions. They're capital questions. Whether anyone labels that way or not, that's what they are. And you hear them early in the process, when the options still exist, because there's not a burning fire. And that timing advantage is the first reason that accountant-originated deals tend to be cleaner. And next, I'll show you two other advantages that lenders care about just as much. Brokers inherit urgency. Accountants observe trajectory. It's a critical distinction. Brokers are usually called right after the pressure becomes significant. Cash is tight, contracts are signed, flexibility is gone. And accountants are seeing the same situations, but they're seeing them forming a few months earlier. You see the liquidity tightening before it becomes a crisis. You see growth pressure before working capital has broken. You see capital expenditures being discussed before the vendors are involved and selected. And that clear early visibility improves deal quality. And there's two other advantages that compound this. First, data quality. You're working with real financials, context, history, defensible adjustments, and that reduces underwriting friction from the lenders immediately. And second, you have a trust position. When an accountant says, we need to think about capital, clients listen differently. And timing, the data, the trust from working together is powerful leverage. But this leverage only works if the transition is handled correctly. And most people get this next transition piece wrong. So here's what fails: trying to sell loans, talking like a broker instead of an advisor, chasing after every possible deal, competing on rates and speed. All of these fail because when accountants abandon their advisory posture, things become transactional and credibility erodes, and clients feel that, even if they can't clearly explain it. The accountant who tries to outbroker commercial loan brokers usually loses. But the accountant who becomes a capital advisor to their clients usually wins. So, what does the right transition actually look like without burning bridges or blurring roles? Let's talk about this next. The winning move here is not a career switch. It's a bridge, one where you remain the accountant. You remain the trusted advisor in the room. But what changes is what you're willing to own, to bring to light, and to talk about. The bridge shows up in very specific moments. It shows up when you see growth outpacing working capital, or tax strategies creating a near-term liquidity pressure, or equipment or real estate expansion needs, or a need to refinance debt that no longer fits the business. And when you see these patterns, you don't pitch a loan. You surface what the numbers are already saying. Capital enters the conversation as a consequence of the planning session, not as a product that you are recommending. And this is where ethics matter most, and where many people hesitate. So in the next section, we'll explore what ethical client support looks like and compare that to sleazy cash grabs. Having the ability to place a loan for a client does not mean that you must or should do so. Placement is a tool, not a mandate. Sometimes the right answer is to place capital, and sometimes it's to introduce another partner, and sometimes it's to recommend that your clients wait and do nothing. Clarity, not activity, is what protects your credibility. And this systems-based view is supported by industry research. A joint study recently by the Hinge Research Institute and CPA.com surveyed over 650 different accountants and business clients and found that strategic advisory services represent the single biggest revenue opportunity for accounting firms today, with the potential to increase monthly client revenues by up to 50%. But that growth isn't automatic. It depends on judgment, trust, and proper integration. Capital strategy strengthens the advisory model, but only when it supports your system of client value rather than replacing it. So next, let's dig into the financial impact for accountants, because this shift fundamentally changes how accountants can get paid. For most accountants, most of the time, income is tightly coupled to time invested. But advisory begins to decouple that, but still with ceilings. Capital placement, it introduces a completely different dynamic. And this isn't theoretical. Research from Thomson Reuters found that accounting firms who moved into advisory services saw a 133% increase in average first-year billings for new clients. It also found a 113% increase in average monthly billing for existing clients. And this doesn't come from working longer hours. It comes from moving upstream into decision making for your clients. One well-structured commercial deal can easily exceed a year of tax prep fees for a single client. And that's not because it's easy money. It's because the value created is disproportionate to the time involved, and compensation begins to align with the impact you have on your client. And that said, this path isn't for everyone, and that's important to speak to clearly. So let's dig into who this path is not a good fit for. This works best for client-facing accountants, for advisory-minded professionals, for people who are comfortable providing recommendations with judgment and nuance. but it's a poor fit for pure technicians, for compliance-only mindsets, or for anyone who's just looking for shortcuts to a passive income. If you're hearing about this business model and you're thinking it will be an easy route to squeeze some more money out of your current client base, you should not be offering capital advisory services. You should not. On the other hand, if you're thinking, wow, Jim or Carla or Stefan or whatever client would really benefit from some proactive support in getting capital for their business. If you're thinking I should pick up the phone and call them today, regardless of whether I make a $20,000 or $30,000 commission on the financing, then you're at the right place. You're putting client support first. You're increasing the value that you provide to your clients at the same time that you increase the revenue for your agency. Capital advisory amplifies the success of your clients, and if that is your goal, it's a good fit. If your clients already trust you with their numbers, the most sensitive information on their business, then the capital decisions already live inside your world. The question is whether those decisions are being addressed early on and thoughtfully, or if they're being outsourced downstream to others when pressing needs are already limiting your client's options. If it's handled correctly, this path serves clients, it strengthens your credibility, and it creates leverage that few professions out there can enjoy. So get out there, give big to your clients, and let's make this world a better place together.